Ladies and gentlemen, our next guest is a man who needs no introduction. He's somebody I track, and I'm sure many of you in the audience track as well. Professor Nouriel Roubini. He's the man who called the financial crisis, and his musings have always moved world markets. Fittingly enough, he speaks today on the new abnormal in the context of a troubled world economy. Ladies and gentlemen, please put your hands together for Professor Roubini.
Ladies and gentlemen, distinguished guests, it's a great pleasure and honor being here today. I always come regularly to India. It's a wonderful country, very hospitable. It's a really great pleasure being back here. And thanks to the Economic Times for inviting me. Like many of you, I was last week in Davos for the World Economic Forum, and I would say it was a bit of a gap between the overall mood of concern about the global economy. The biggest question was asked over and over again, are we back to 2008 into the risk of a global recession and a global financial crisis? And my answer was no, but there are a bunch of tail risks in the global economy. But on the other side, I was also in a panel on the Indian economy, it was televised, and there was certainly much more optimism about the Indian economy than about the rest of the world. The rest of the world is slowing down while economic growth in India is holding up. If you think about the BRICS, Brazil, Russia, India, China, and South Africa. Two of these countries, Russia and Brazil, are in a recession. One, South Africa, is barely growing. In China, there is a structural and a cyclical slowdown of economic growth down to 6% and eventually 5%, while if there is one part of the global economy among the BRICS that is actually growing in terms of growth, is India. In spite of the global tailwinds coming from the global financial turmoil that are slowing down the world, India is growing above 7%. And in spite of the fact that not all of the structural reforms that have to be implemented, they will be implemented in the future, the Indian growth is still above 7%. So the number could be certainly much higher if the global economic outlook were to become better and if some of those structural reforms were to be implemented. So what I would like to do is to talk to you about what is the global economic outlook, what are the positives, what are the negatives, and then to see how they affect India and what India can do for itself to make sure that this strong economic growth is going to be accelerating over time. Certainly the year started with global financial market becoming very nervous about the global economic growth. And there's been a significant correction of a bunch of risky assets globally, like US and global equities. What are the sources of this turmoil, and are they temporary, reversible, or more structural? The first one is, of course, the concerns about a Chinese hard landing, and if China were to have a hard landing, about the collapse of its currency and the stock market. I've been saying for a number of years that China is not going to have neither a soft landing, meaning growth 7% plus, nor a hard landing, meaning a severe recession. The landing of China is going to be bumpy and rough, meaning that growth this year is probably close to 6% rather than the official 7%, and potential growth of China, for a number of reasons, is slowing down by the end of the decade towards 5%. The good news is that if China has only a bumpy landing and a slowdown of growth, the chances of a global recession triggered by hard landing of China are going to be limited, and I think that markets tend to be manic depressive. A year ago, they were believing the excessive optimism of authorities in China, there'll be a soft landing, and now they've gone to the other extreme of arguing the Chinese are incompetent, they're lying and cheating, the growth is not 6, 7, but 4 going to 0, and there'll be a collapse of the currency and the stock market. I don't believe that's the case. There is a slowdown of growth, but is manageable, and China has the policy tool to make sure that growth slows down in a more stable way. So markets are either too optimistic, too pessimistic. And if there is a bumpy landing, then global economic growth is going to continue and a severe global financial crisis will not occur. The bad news, however, is that this slowdown of China has significant impacts. Has impacts on commodity producers, has impacts on advanced economies, has impacts on financial markets, has impacts to trade and financial channels, and therefore it's going to have an impact on the global economy. And the deflationary impact of China is not just coming from its lower demand for commodities, but now there is a glut of capacity in China. Overcapacity in steel, in cement, in aluminum, in many industrial sectors. And a lot of this excess capacity now is either dumped or sold in global markets, and is leading to a surge of imports of Chinese goods in India, in US, in Europe, in other parts of the world. imposing pressure on profit margins, on competitiveness, and deflationary pressures on the global economy overall. So China is not going to cause a global recession, but it's going to be a source of volatility and turmoil. Second factor is leading to this turmoil in markets, concern about US economic growth. The numbers about the fourth quarter are mediocre. There'll be barely positive growth. And because of residual seasonality, weather, and other factors, the first part of the year might not be very positive. And the fall in oil and energy prices that is positive overall for the US economy, since US is a net oil importer, in the short run leads to negative effects on production, employment, and capital spending in the oil and energy sector. So you might have the first half of the year in the US is going to be weak because of the impact on the oil sector, followed by increased consumption only in the second half of the year. People are already saying that since US economic growth is lower, maybe the Federal Reserve made a mistake by raising rates last December. Since last December, there have been three things that suggest that the Fed might have made a mistake. One, growth is surprising on the downside. Secondly, the fall in oil, energy, and commodity prices implies the US inflation is going lower, not higher. And three, the global financial turmoil implies that there are headwinds to and a tightening of financial conditions in the United States, falling stock markets, stronger dollar, widening of credit spreads. All of this is going to have a negative impact on growth and inflation. And the Fed last year told us they're going to hike 4 times this year. I think they're not going to hike 4 times because of these headwinds, at most 3 times, maybe 2 times. That should be positive, stabilizing US economic growth. Third factor that worries people, the rising geopolitical risk in the global economy, starting with the Middle East, where the conflict between Sunni Saudi Arabia and other states in the Gulf and Shia Iran is becoming a Cold War that is leading to proxy wars that are being fought from Syria to Iraq to Lebanon to Yemen to Libya and so on. And eventually turmoil in the Middle East is going to have economic and financial, not just political consequences. The other paradox that we're seeing in the market today is that there is another significant fall in the price of oil. And the fall in the price of oil should be on net a positive for the global economy. Why? Because we're redistributing income from those countries, oil exporters that have a higher marginal propensity to save, to countries that are on net oil importing, that are having a higher marginal propensity to spend. United States is still a net oil importer. Europe, Japan, China, India, Korea, the industrialized countries in Asia, Turkey, and so on. Of course, the fall in oil prices reduces also the income and create fragilities in the oil exporters, but on net should be a positive for the global economy. However, every time oil prices fall, US and global equity tend to fall rather than rise. How is that explained? There are 3 reasons. First of all, some people worry that the fall in oil prices is not driven by a positive supply shock, the latest one being the return of production and exports of Iran to the global market following the phase-out of the sanction, but rather due to weakness in global aggregate demand. Chinese growth is weak, emerging market growth is weak, even US growth is weak. If the fall in oil price is a signal of weak growth and aggregate demand, is a signal of something wrong. That's why global stock market react negatively. Secondly, in the United States, of course, production of oil and energy is significant, and the fall in oil prices hits producers by cutting their production, employment, and capital spending faster and sooner than the positive impact on the disposable income and then the consumption of the household sector. And in the first half of the year, the negative impact is going to be bigger, and we're going to have to wait until this windfall on income is going to be spent in the second half of the year. And a large share of the US S&P 500 stock market is weighted by oil and energy and related sectors. 3, for those that are oil exporters, there is a risk of credit events. Some of them are near insolvent, like Venezuela. Other ones are very fragile. If oil prices were to remain below $30 per barrel, there is a risk of credit events in a number of these countries, in their state-owned enterprises, their own corporates, their own sovereign as well. In a world in which US energy firms are in trouble and other firms in emerging markets are in trouble because of the fall in oil, energy, and commodity prices, and you have also market illiquidity, any economic shock can lead to a widening of credit spreads for sovereigns and for corporates that is more than is justified by the fundamental. Because right now, market makers in the financial system are doing less market making because of higher regulation on capital and on liquidity and less ability to do prop trading. So the combination of market illiquidity and economic shock can lead to credit events that are going to be something that could eventually be systemic if there was an economic downturn. Final source of tail risk for the global economy. What's happening right now politically in Europe and the Eurozone? On one side, the Eurozone is in an economic upswing. The latest data on Europe are actually suggesting an improvement of growth, while there is a slowdown of growth in the United States. It's not surprising. The European Central Bank has done quantitative easing. Therefore, there is a fall in bond yields, in spreads of the periphery, a fall in the value of the euro. Oil at $30 a barrel as opposed to 100 is a boon for Europe importing most of its oil and energy. There has been a rise in the stock market. If this easing of financial conditions is not going to lead to a cyclical recovery of the Eurozone, what else will? However, there are political problems in the Eurozone. The time bomb of the migration crisis. This is not just 1 million people have come from the Middle East to Germany this year alone, but there are 15 to 20 million people between Middle East, North Africa, and Sub-Saharan Africa that have been displaced by war and economic dislocation. Global climate change is leading to desertification. Desertification is leading to a collapse of water resources, collapse of agriculture and of economic activity. Sunni, Shia, Alawites, Kurds might not like each other, but when there is economic desperation, they start to kill each other. Let's not forget you had 4 years of a drought in Syria before the civil war started. And this is an existential threat to Europe. It's not the problem of 1 million people this year, but 15 to 20 next year might try to desperately come to Europe. And that's something that's socially and politically unstable for Europe. So you have the migration crisis, you have terrorism. The issue is not whether there'll be other terrorist attacks in Europe, but only when and where. And you have now the risk of Brexit, British exit from the European Union. The risk of Grexit or Greek exit from the Eurozone has not been reduced, might have been only postponed. And now you have populist party of the right and the left that are becoming more noisy, both in the periphery of the Eurozone and the core of the Eurozone. There is austerity reform fatigue in the periphery, there is bailout fatigue in the core, and the two things may be clashing. So in Europe today, we have the paradox that while the real economy is doing better, given the policy of the central bank, the political challenges to Europe are becoming more serious. And people are starting to talk about the risk of a beginning of the end of the Eurozone, beginning of the end of the European Union. Now, not everything is going to go wrong in the global economy. And I think that the positive argument you can make are several. First, while many of these problems are there, many of these risks are there, things are not going to be so bad. The economic data from China might surprise on the positive side and not show a free fall. The US data may be a source of nervousness, but actually economic growth in the US is positive. The traded sector is not doing very well, but the non-traded sector is doing well. GDP growth is anemic, but the labor market is strong. So the mixture of the data is actually a complicated one, and I think that data from the US could surprise on the upside. So the economic data may prove to be better, and more importantly, in the past, whenever we had risk-off episodes, bad news have become good news for the financial market once there has been a policy reaction by the monetary and other authorities. It's likely that in China, the central bank, the PBOC, is going to do another round of monetary easing. The fiscal stimulus can be increased at the central level to try to backstop economic growth. The European Central Bank has already signaled they're going to do additional monetary easing in March. And just overnight, the Bank of Japan decided to go negative with its policy rate as a way to try to boost economic growth and avoid deflation in the case of Japan. And while the Fed has been saying until now we're going to hike this year 4 times, given the lower economic growth, given lower inflation, given the financial headwinds in the world economy, and the risk of higher interest rates in the US and higher value of the dollar, my view is that even the Fed is going to decide to hike much more slower than otherwise. Not in March, maybe not even April. Maybe the first hike this year is going to be June. And that might be sustaining economic growth in the United States and sustaining growth also and financial condition in the global economy. So a lot is going to depend on economic policy leadership, by the right economic and financial policies, and of course, by what's going to be happening in the private sector. Let me talk now about how this global economic outlook affects or doesn't affect India. As I pointed out, India is a country that has been growing robustly, 7% plus, even in a situation in which many of the economic reforms still have to be made, and even in a situation in which globally the variety of headwinds that are hitting the global economy have an effect on India. For example, even in India, the stock market has fallen by 20%. however gradually. Even in India, the global financial contagion has implied that the value of the currency has been falling. That might be good for exports and import competing sector, but of course there is a risk that's going to lead to higher inflation and eventually slow down the pace at which the central bank can ease monetary policy. The dumping by China of the excess supply and capacity of goods in global market implies that now there is a surge of exports of China to many parts of the world, including India. And that has been an element of concern about the industrial sector in the case of India. So the key thing in India is that right now, on a number of dimensions, things are better than they were a few years ago. 2 years ago, India was put together among the fragile five because he had twin current account and fiscal deficit, rising inflation and falling economic growth. So it was considered as a fragile economy. But while some of the fragile five are as fragile today, if not more fragile than before, for example, Turkey and Brazil, the macroeconomic outlook of India has improved significantly. Monetary policy has been tight, but has been important under the leadership of the new governor of the central bank to make sure that inflation is under control and falling over time. High inflation is not beneficial for any economy. There has been fiscal adjustment as well with a reduction of the budget deficit. Of course, India also got lucky because the fall in oil, energy, and commodity prices for a country that is a net commodity importer has been actually an element of luck. It has reduced the current account deficit in a positive direction, and by being able, the government, to reduce some of the subsidies, it also has reduced the budget deficit. So that has led to an improvement of the twin deficits on the current account and the fiscal balance of the country. There is a lively policy debate today in India on many things. I often go to China, and China's account is not transparent, where people are not willing to discuss in public openly what are the right policy, to criticize or being supportive of the government. I think one of the great things about India is a vibrant democracy, and there is a lively debate, and there is openness, and people being willing and able to discuss things, and they disagree or agree on what economic policy is going to be. For example, there is a debate today on monetary policy. Is it too tight or not tight enough? Some people suggest that while the CPI inflation is still above target, 6% plus, the wholesale price index is in a negative territory, and therefore maybe credit condition and real interest rates are too tight. On the other side, given global financial headwinds and the weakening of the currency, the central bank has to be worried that the rise in inflation is going to lead them to even more tightness of monetary policy. So being cautious on reducing interest rates only when inflation as measured is falling probably may be the prudent policy. But maybe policy could be too tight. There is also debate about fiscal policy. The budget deficit in India for a while was too high, has been reduced, and that should be reduced on a structural basis even more, but there are now these global economic headwinds. There has been an argument made that maybe the budget for next year should be slightly looser by increasing the amount of public investment as a way of boosting aggregate demand at a time where private investment is weak. That's certainly a sensible argument. On the other side, it's key to maintain credibility with the markets, to make sure there is a structural adjustment of fiscal policy over time, because if other bad times were to occur, and there's a concern that the deficit is too high and then it's monetized, the pressure on the currency might be damaging. So finding the right balance is a difficult one. On credit growth, there has been a slowdown of credit growth, and I think there is an open discussion on whether this is driven by credit supply constraint, a credit crunch, as the banks are becoming more cautious about lending to the private sector or state-owned enterprises, some of which have too much high debts, or whether there is a credit demand problem. I think that's an open discussion. But I think the key issue is about structural reforms. There is obviously a lot of structural reforms that have occurred, even if some of the big headline ones are still to be implemented. I think that people can look at the part of the glass that is half full or the part of the glass that is half empty. A lot has been done, but much more needs to be done. The GST reform is certainly important. Having a system to deal with retroactive taxation, to have clarity, is important. Land and labor reform maybe are going to occur at the state level rather than the central level. You need a bankruptcy reform. You need further liberalization of foreign direct investment. Much more needs to be done on ease of doing business, reducing the cost of doing business and reducing red tape. Banks and corporate sector cleanup when there is too much bad debts and bad assets and bad liabilities is going to be also important. And gradually phasing out a number of subsidies that are actually fiscally costly on fuel, on fertilizer, on food, or a correct pricing of the use of water, and power is going to be also important. I think that the positive news that these reforms are occurring and are going in the right direction, even if, of course, the speed of this reform occurring may not be as fast as one would want from an optimal point of view. So the key point about India, you're going in the right direction. There are global headwinds that implies that macroeconomic adjustment and structural reform are going to make you more resilient, are going to be the right policy ahead of you. I'm quite confident that's the direction India is going, and it's going to be very successful in the next few years. Thanks very much.
Thank you, Professor Roubini.